Cap rate is a indication of risk on the property. That's really it. If you're buying something that's in a rough part of town that you're going to have a lot of vacancy loss, you're going to have a lot of tenants that aren't going to pay, that's typically going to trade at a 12 cap. If you have a property that's an 8 cap investment, it's going to be a little bit safer as far as collections. Tenant base is going to have a higher credit score, all that sort of stuff. It's just going to be a easier property to manage. The risk is going to be lower, so the cap rate's going to be lower as well. The higher the ROI, the riskier the investment. It's the same way in the stock market as it is in real estate. So if you see a high cap rate property, you might think you're getting a deal, but just know that you're gonna have some struggles getting that property turned around. Now, as far as how you add income to a property, it really breaks down to two different things. You either save money on expenses or you add revenue. So if you do a $200 a month rent raise across 30 units, that's going to be what, $6,000 a month. That $6,000 a month will move the needle a lot more on an 8 cap investment than it will on a 12 cap investment. But just for grins, we're going to see what happens when we increase the NOI by $3,000 a month. So if I take $8,000 a month and I multiply it by 12, the 12 months in a year, and then I divide that by 0.12 being 12% for the cap rate, I'm going to get an $800,000 evaluation, which means I moved my $500,000 property to $800,000 in value. And what did I have to spend to do that? Does it cost anything to raise rent? Well, gurus will tell you no, but I'm here to tell you it will cost you something. You will have move outs, you will have vacancy loss, and you will have make readies that will go into it. But theoretically, it doesn't cost anything to raise the rent the way that they explain it.